Stop whatever you're doing right now. Tell your kids to be quiet for 20 minutes, or they are grounded. Just tell everybody in the house or at work, I am watching John A. Please do not disturb. Go airplane mode. Because if you get distracted in the next 20 minutes, if you miss what I am about to tell you, you're going to regret it for the rest of your life. Are we clear? Good. Ladies and gentlemen, Asian guy here. Yesterday, Thursday, January 15th, something historic happened. Something that has not happened in 30 years. For the first time since the mid-1990s, central banks around the world now hold more gold in their reserves than U.S. Treasury debt. Let me say that again. Central banks hold more gold than U.S. dollars, more gold than U.S. bonds, more gold than American debt. This is the crossing of the Rubicon. This is the moment when the global reserve currency, the U.S. dollar, officially lost its monopoly. This is the moment when the world said, we do not trust you anymore. And if you do not understand what this means, if you do not understand the implications, you are about to get a very expensive education. So shut up. Listen, and let me explain exactly what happened and why it means silver is about to explode to levels that most people think are impossible. Let me start with the gold story, because this is the foundation of everything else. For the last 50 years, since the Bretton Woods system collapsed in 1971, the US dollar has been the global reserve currency. Every country in the world holds dollars in their reserves, or they hold US Treasury bonds. They hold American debt. Why? Because they need dollars to buy oil. They need dollars to conduct international trade. They need dollars because that is how the system works. But there's a problem. The US government keeps printing more dollars. The debt keeps going up. The deficit keeps getting bigger, and the value of each dollar keeps going down. So for years, foreign countries have been nervous. They have been watching the US government spend money like a drunken sailor. They have been watching the Federal Reserve print trillions of dollars to bail out banks. They have been watching the debt go from 10 trillion to 20 trillion to 30 trillion to now over $36 trillion. And they have been asking themselves, how long can this go on? And more importantly, what happens when it stops? So quietly, slowly over the last few years, they have been diversifying. They have been buying gold. China has been buying gold. Russia has been buying gold. India, Saudi Arabia, Turkey, Poland, all of them have been buying gold. And now for the first time in 30 years, the total amount of gold held in central bank reserves exceeds the total amount of U.S. Treasury debt held in reserves. This is a seismic shift. This is a vote of no confidence in the U.S. dollar. This is the world saying, we do not trust your paper anymore. We want something real. And gold is real. Gold cannot be printed. Gold cannot be inflated away. Gold is neutral. It is not controlled by any government. It is not subject to sanctions or seizures. And that is exactly what makes it attractive right now. Because the US government has weaponized the dollar. They froze Russia's dollar reserves when the Ukraine war started. They threatened to do the same to China if they move on Taiwan. They use the dollar as a tool of foreign policy. And the rest of the world sees this, and they are terrified. They are thinking if the US can freeze Russia's dollars, they can freeze ours too. So they are getting out. They are selling treasuries. They are buying gold. And this is the beginning of the end of dollar dominance. Now you might be thinking, okay, John, that is interesting, but what does this have to do with silver? Everything. Because if central banks are fleeing the dollar and buying gold, what do you think private investors are going to do? What do you think corporations are going to do? What do you think wealthy individuals are going to do? They are going to follow the central banks. They are going to buy gold, and they are going to buy silver. Because silver is gold's little brother. Silver is the poor man's gold. Silver is the asset that moves 10 times faster than gold when the monetary system is in crisis. And we are in a monetary crisis right now as you watch this video. And the people who understand this are buying silver with both hands. Which brings us to what happened yesterday, Thursday, January 15th. Silver hit $92 per ounce. $92. That is up from $30 just 6 months ago. That is a 200% move. That is the kind of move that makes people very, very rich. But then something happened overnight. While the Western markets were closed, the price crashed. It went from $92 down to $87 in a matter of hours, a $5 drop in the illiquid overnight market. And this morning, when people woke up, when they checked their brokerage accounts, they saw red. They saw a 5% pullback, and they panicked. They thought, oh no, the rally is over, I should sell. But that is not what happened. That overnight crash was not a correction. It was not profit-taking. It was a survival move by the banks. Let me explain. The banks, the big commercial banks like Bank of America, Citigroup, HSBC, JP Morgan are short silver. They have been short silver for years. They have sold paper contracts that they do not have the metal to back. And now the price is going up and they are losing money. A lot of money. Let me give you the numbers. According to the latest data, The commercial banks are short approximately 4 billion ounces of silver. 4 billion. That is their total short position across all exchanges, all contracts, all derivatives. Now, at $90 per ounce, what is the value of that short position? 4 billion ounces. $90 equals $396 billion. $396 billion. That is how much the banks would owe if they had to close their positions at $90. Now, let me put that in perspective. The market capitalization of Bank of America is approximately $250 billion. Group is around $120 billion. So if silver stays at $90 or goes to $100, the losses on the short positions would exceed the entire market value of some of these banks. They would be insolvent, they would be bankrupt, they would need a government bailout. And the banks know this. So what did they do? They panicked. They smashed the price overnight. They dumped massive amounts of paper contracts into the illiquid Asian and European trading sessions. They triggered stop losses. They forced margin calls on leverage traders. They created fear and panic, and they bought themselves some time. But here's the key thing. They did not fix the problem. They just delayed it because the fundamentals have not changed. The physical shortage is still real. The industrial demand is still exploding. The vaults are still empty. And the price is going to come back. And when it does, when it breaks through $95 and heads toward $100, the banks are going to be in even more trouble because they just showed their hand. They just proved that they are desperate, and desperate banks do desperate things. Now, let me show you the proof that the physical shortage is real, because while the paper price dropped from 92 to 87, something very interesting happened in the physical market. The lease rates went vertical. Let me explain what lease rates are. When someone wants to borrow physical silver, when they need metal for industrial use or to cover a short position, they have to pay a fee. That fee is called the lease rate. It is like an interest rate for borrowing metal. In a normal market, the lease rate is very low, maybe 0.5% and or 1% per year. Because silver is abundant, there's plenty of metal available to borrow. But right now, the lease rates are spiking. They're going to 5%, 10%, 15%. Some reports show lease rates as high as 20% in certain markets. Why? Because there's no metal available to borrow. The vaults are empty, the physical silver is gone, and the people who need it are desperate. They are willing to pay 15 or 20% just to get their hands on metal for a few months. This is called backwardation. It is when the spot price is higher than the future price. It is when people want the metal now, not in 6 months. And backwardation is a massive red flag. It is the market screaming there's a shortage. So while the banks were busy crashing the paper price from 92 to 87 to make it look like the rally was over, the physical market was screaming the opposite. The lease rates were saying, we cannot find metal, we need it desperately, and we will pay whatever it takes. This is the disconnect. This is the proof that the paper price is a lie. And this is why the rally is not over. It is just getting started. Now, let me tell you what happened in Shanghai, because Shanghai just confirmed that the endgame is here. Yesterday, Thursday, January 15th, the Shanghai Futures Exchange announced new position limits. They are slashing the maximum position size for silver contracts from 7,000 lots down to 3,000 lots. That is a 57% reduction, effective on the 9th session of January 19th. Why would they do this? Why would an exchange suddenly cut position limits in half? Because they are running out of physical metal to deliver. They are seeing the delivery requests pile up. They are seeing the vaults drain, and they are terrified that they will not be able to fulfill their obligations. So they are forcing traders to delever. They are reducing the size of the bets that can be placed. They are trying to reduce the demand for physical delivery. This is a soft force measure. This is the exchange saying we cannot handle the volume. We need to slow this down before the whole system breaks. And if you do not think that is significant, you are not paying attention, because Shanghai is the largest physical silver exchange in the world. It is where the real price is set. And if Shanghai is running out of metal, that means the global market is running out of metal. This is the end game. This is the moment when the paper market loses all credibility and the physical market takes over. And when that happens, the price is going to explode. Now, let me address the elephant in the room. Yesterday, a rumor started circulating on the internet. People were saying that Rick Rule, one of the most respected investors in the precious metal space, sold all of his silver, and people were panicking. They were thinking, if Rick Rule is selling, should I sell too? Oh, let me give you the truth. Because the truth is very different from the rumor. Rick Rule did not sell all of his silver. He sold 80% of his physical silver position. But here's the key detail. He sold it to take profits. He recouped his initial investment plus enough to pay the capital gains taxes, and now he is writing the remaining 20% on house money. At the same time, he added to his silver mining stocks. He bought more shares in silver producers and explorers. Why? because the mining stocks have leverage. If silver goes from $90 to $150, the miners could go up 300% or 500%. Rick Rule is not bearish on silver. He is de-risking his position and moving into higher leverage plays. This is what smart investors do. They take profits when they have a huge gain. They lock in their returns, and then they redeploy the capital into opportunities with more upside. So if you saw the rumor that Rick Rule sold his silver and you panicked, you got played. The truth is much more nuanced. And the truth is that even Rick Rule, who is taking profits, is still very bullish on silver. He just moved his exposure from physical to miners. That is not bearish. That is smart risk management. Now let me tell you about the most insane forecast I have heard in a long time. Bank, a major asset management firm, just released an updated forecast for the price of gold, and it is mind-blowing. They're using a model called the Jim Sinclair model. It is named after Jim Sinclair, a legendary gold investor who correctly predicted the gold bull market of the 1970s. The model is very simple. It takes the total money supply, M2, and divides it by the amount of gold held in reserves. The result is the fair value of gold if gold were to back the currency supply. In 2007, when Jim Sinclair updated the model, he predicted that gold would go to $50,000 per ounce. At the time, gold was trading around $700. Everyone thought he was insane, but his logic was sound. He said, if the government keeps printing money, if the deficit keeps growing, if the debt keeps exploding, eventually they will have to devalue the currency. And when they do, they will revalue gold to back the system. And sure enough, gold went from $700 to $1,900 over the next few years. It did not hit 50,000, but the trend was correct. Now, in 2026, Van has updated the model with the latest data, and the new forecast is $184,000 per ounce of gold. $184,000. Let me say that again so it sinks in. $184,000 per ounce. Not 4,000, not 10,000, 184,000. How is that possible? Because the money supply has exploded. M2 in the United States is now over $21 trillion. And the amount of gold held by the US government is roughly $260 million ounces. If you divide 21 trillion by 260 million, you get approximately $80,000 per ounce. But Bank is not just looking at the US. They are looking at the global money supply. And when you factor in the entire world, the number goes even higher, $184,000. Now, I'm not saying gold is going to $184,000 next month. I'm not saying it is going to happen in 2026, but I am saying that the math is there. The model is there. And if the monetary system collapses, if the dollar loses its reserve status, if central banks have to reback their currencies with gold, $184,000 is not crazy. It is actually conservative. And if gold goes to $184,000, where does silver go? Historically, the gold to silver ratio has been around 15 to 1. That means for every ounce of gold, you get 15 ounces of silver. If we use that ratio and gold is at $184,000, silver would be at $12,267 per ounce. $12,000 per ounce. Now, I do not think the ratio will get that tight. The ratio has been much higher in modern times. But even if the ratio is 60 to 1, which is where it was recently, silver at $184,000 gold would be $367 per ounce. $3,000, that is 33 times higher than the current price. So when I tell you that the target for silver is $300 or $500, I am not being aggressive. I'm being conservative. The VNC model suggests that the upside could be much, much higher. Now, let me bring this all together because I want you to see the big picture. Central banks are fleeing the dollar and buying gold. The banks are short 4 billion ounces of silver and facing $396 billion in losses. Shanghai is cutting position limits because they are running out of metal. The lease rates are spiking because there is no physical silver available. Rick Rule is moving from physical to miners to capture more leverage. And Vanek is forecasting $184,000 gold, which implies multi-thousand silver. All of these data points are telling you the same thing. The system is breaking. The monetary order is collapsing. And hard assets, gold and silver, are the only safe haven. So what do? If you own physical silver, you hold. You do not sell because the price dropped from 92 to 87. You do not sell because you saw a rumor about Rick Rule. You do not sell because some talking head on CNBC says the rally is over. You hold because the fundamentals are screaming, the end game is here, and the price is going to levels that most people cannot even imagine. If you own paper silver, ETFs, futures contracts, you need to seriously consider your risk because when the system breaks, when the force majeure is declared, you might get cash settled at $87 while the physical market trades at $200. Is that a risk you want to take? If you do not own any silver, you need to buy now, not next week, not when the price dips back to $70. Now, because the window is closing, the dealers are running out of inventory, the mints are backed up for weeks, and the premiums are exploding. If you wait, you might not be able to get any metal at any price. Now, let me address the people who think the dip to $87 is the start of a bigger correction. The people who think silver is going back to $75 or $70. You're wrong, and here's why. The dip to 87 was not driven by fundamentals. It was driven by manipulation. The banks smashed the price in the illiquid overnight market to save themselves from bankruptcy. But they did not solve the underlying problem. The physical shortage is still there. The industrial demand is still there. The vaults are still empty. Shanghai is still cutting position limits. The lease rates are still spiking. Nothing has changed except the paper price. And paper prices can be manipulated, but physical reality cannot. So the price is going to come back. It is going to recover. And when it does, it is going to blow through $92 like it was never there. And then it is going to head toward $100. And that is when the banks are really going to panic. Because at $100, their losses are not manageable anymore. At $100, they need a government bailout. At $100, the system breaks. And we are going to get there. Maybe not today, maybe not next week, but we are going to get there. And when we do, you are going to be very glad you held your silver. Now, let me talk about the timeline, because people always ask me, John, when is this going to happen? When is silver going to $100? When is the force major coming? I do not know the exact date. Nobody does. But I can tell you that we are very, very close. The signs are everywhere. Shanghai cutting position limits, lease rates spiking, central banks buying gold, banks facing $396 billion in losses. All of these are endgame signals. My guess, and it is just a guess, is that we have weeks, not months. Maybe we have a few months, but we do not have years. The system is too fragile. The pressure is too high. Something is going to break, and when it does, the price is going to explode. So if you are waiting for the perfect time to buy, the perfect time is now. Because by the time it is obvious to everyone else, it will be too late. The metal will be gone, the price will be $200, and you will be kicking yourself for not acting when you had the chance. Now, let me give you one final thought. The reason the banks are so desperate right now, the reason they smashed the price to $87 is because they know what is coming. They know that they cannot hold the line much longer. They know that the physical market is going to overwhelm the paper market. They know that the squeeze is coming, and they are terrified. And when your opponent is terrified, when they are making desperate moves, that is not the time to fold. That is the time to hold. That is the time to press your advantage. That is the time to look them in the eye and say, I am not selling. So do not let them shake you out with a $5 dip. Do not let them scare you with fake news or rumors. Do not let them manipulate you with overnight crashes in liquid markets. Hold your silver. Trust the fundamentals and wait for the inevitable moment when the paper market collapses and the physical price takes over, because that moment is coming. The central banks buying gold instead of dollars proves it. The Shanghai position limits prove it. The spiking lease rates prove it. The $396 billion loss that the banks are facing proves it. All the evidence is screaming the same message. The system is breaking. The end game is here, and silver is going to the moon. So hold the line, do not panic, do not sell, and get ready for the ride of your life. This is John A.G. from Currency Archive. It is Friday, January 16th, 2026. Central banks just chose gold over dollars for the first time in 30 years. Banks are facing $396 billion in losses if silver hits 100. Shanghai is cutting position limits. The lease rates are spiking. Rick Rule is moving to miners for more leverage. And Vanik is forecasting $184,000 gold. The dip to $87 is a trap. It is the banks shaking the tree one last time before the explosion. Do not fall for it. Hold your silver. The target is $300, $500, maybe more. The force major is coming. The end game is here. Remember to like, subscribe, and share. Hold the line. Do not let them steal your